It's a triple greatest bubble of all time times three in the sense that it's real estate, stocks, and other asset classes. So yeah, I do. That is my. If you're Argentine and you borrow in dollars and you print pesos, how are you going to pay the dollars back unless you have, huge trade surpluses, which they don't. So they just default. Argentina is a serial defaulter and everyone expects that. If you borrow in dollars and you print dollars, which the United States does, they're like, what's the problem? Just print the dollars and pay the money back. Well, that's true. If you print dollars, there's no reason to default on dollar debt because you actually can print the money and buy the bonds. But it doesn't mean nothing else bad happens. What about inflation or hyperinflation? What about a foreign exchange rate? The exchange rate can collapse. And these modern monetary theorists show very little understanding of the international aspects. They treat the US like a closed economy, which it's not. If it were a closed economy and we didn't have to worry about trade deficits, trade surpluses, capital flows, exchange rates, foreign credit, China owning $1 trillion of US Treasury securities, which they do. If you didn't have to worry about any of that, I think they'd probably still be wrong, but they'd have a better case. But you do. She says, well, we don't really need a bond market, US bond market. We only have a bond market as a favor to investors because it gives them a place to put their money. They say when inflation happens, raise taxes. By the way, they also say you don't need a tax system because if you can just print the money, why do you have to collect taxes? And their answer is, we collect taxes to redistribute income. Okay, well, at least they're honest. I mean, that's kind of a socialist model, but they're honest about it. If you ask the typical member of Congress to define modern monetary theory, they'll look at you funny. They've either never heard of it or they certainly don't know what it means, MMT, Acting in accordance with modern monetary theory. Whether they know it or not doesn't matter. The actual behavior, let's go back to COVID, as we talked about the debt to GDP ratio. So Trump put through a $2 trillion COVID relief package. And that was when, the Paycheck Protection Plan, that was $800 billion, and everyone got the $1,200 check. And then at the end of December, at the very end of the Trump administration, they did another $1 trillion almost. And that's when everyone got the $600 checks. And now you're up to $1,800. By the way, those checks, that is helicopter money. What the Fed does is nonsense. But when it's fiscal policy, not monetary policy, and you're handing out checks, that is helicopter money. And credit to Larry Summers for saying, you're going to get inflation out of this. Well, Biden comes into office in January 2021, and he's like, not to be outdone. He did his own COVID relief package. That was another $2 trillion. And that's when we all got the $1,400 checks. They just handed them out. And then later that year, they did the $1 trillion infrastructure package. And then, just to top it off, what did we get recently was the just under $1 trillion Green New Deal, or I call it the Green New Scam. And the baseline budget deficit, before everything I just described, the baseline budget deficit was about $1 trillion a year. So take $1 trillion for 2020, 2021, add on, $2 trillion for Trump's first package, $1 trillion for his second one, $2 trillion for Biden's first package, $1 trillion for the Green New Scam, and I think $1 trillion for infrastructure. That's $7 trillion on top of the $2 trillion baseline budget deficit. So that's $9 trillion piled on top of what was at the time about a $21 trillion national debt. So that's how we got to 30 trillion. That's how the ratio went from 106 to 131. These numbers are mind-boggling, and MMT says it doesn't matter. But it does matter, and it shows up the way I described earlier, which is it slows growth. You don't get growth. So best case for the U.S. is very slow, weak growth, which we saw from 2009 to 2019. Worst case is you throw a recession on top of that, which we're heading for, and the U.S. will be in fiscal distress. If we're on the verge of a global liquidity crisis, as revealed by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with the yield to maturity below what the Fed will give you for a phone call. I mean, all those things are happening. That's hard data. And it's a very, very troubling sign, last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last, how are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? We're putting up inflation numbers today that are the highest in 40 years. That is correct. A little 41. Actually, it was 1981 before we saw these numbers. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. It wasn't the beginning, but it had started. I mean, in some ways it started in 1968 and it really took off in 1974, 75. So 81, these numbers, that was when Volcker finally got it under control. But you go back to 80, 70, well, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50. In that 5-year stretch. So you were putting up numbers, 10%, 11%, 13% and higher year after year. Yeah, 1981, it was, 9 or 10, which is what they're comparing it to today. But that was on the downslope. It had been higher than that in 77, 78, and 79. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Is it different than that? But keep that in mind, because the 40-year comparison, it is correct, but that was the tail end of an even worse episode. Third quarter was a lot stronger, 2.6%. But when you dissect that, what you see is that was almost 100% driven by net exports. When was the last time the United States had positive GDP driven by net exports? Probably 1959. I mean, that's typically a drag on growth, and we've been running trade deficits forever. That meant that people were still buying U.S. goods, but we were not buying as much from other people. That's indicative of a slowdown. Consumption was weak, private investment was weak, inventories were weak. Those are the real drivers of the economy, and they were all weak. So, okay, net exports, that's not sustainable. So I would look for a recession, a more severe recession, to begin in the fourth quarter. That's one, combined with Fed tightening, interest rate hikes, balance sheet reductions, etc. That's one whole vector, and I wouldn't put any weight on a low unemployment rate. It ignores labor force participation rate, which is awful. It's down around 62% versus 70% in the year 2000. But beyond that, unemployment is a lagging indicator. Unemployment goes up after a recession begins. Employers are very reluctant to lay off employees. You got to pay severance. It's expensive to recruit and hire them back and train them. So you pretty much wait until the recession has already started, and you can, all right, I got to lay some people off. So it's not a leading indicator, it's a lagging indicator. So the Fed is behind the curve. There's a brewing global liquidity crisis, a global financial crisis that's different from a recession. It's financial panics and recessions are two different things. They can come separately. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. They can come together. It looks like they might be coming together again. This is revealed in inverted yield curves. Major dealers are bidding at auction for treasury bills. Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3, in the sense that it's real estate, stocks, and other asset classes. So
Hey guys, welcome back to Nifty Invest. In this video, Jim Rickards discusses the relationship between interest rates and the business cycle and the different indicators that suggest an economic downturn may be on the horizon. He notes that interest rates are a lagging indicator and that business owners, entrepreneurs, and medium-sized businesses are often the first to notice when a recession is imminent. He also points out that while the stock market is predicting a soft landing, the bond market is signaling that a recession is coming, and that the inversion of yield curves is a particularly worrisome indicator. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get close to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. But the stock market is saying, yeah, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, this is the soft landing Goldilocks scenario, where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks. If you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3, in the sense that it's real estate, stocks, and other asset classes. So yeah, I do, that is my view, but it's shared by a number of other analysts. 1929, everyone's like, yeah, October, I think 18th or 19th, it was late October 1929, the stock market fell 22% in 2 days. It wasn't one day, it was like 12% one day, 11% the next day, so 23% over 2 days. But that wasn't the crash. That was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years, but that fell 82%, and that happened. So yeah, we're down. Nasdaq's down, bounced back a little bit in recent days, down close to 30%. Down, the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, full market adjustment looks like in the face of the kind of recession that I expect.
Jim Rickards explains that interest rates are a lagging indicator, and that people like to question how they could go up if we're in a recession. However, as we get closer to a recession, business people like entrepreneurs, restaurant owners, and taxi drivers are the ones who figure it out first, not the Federal Reserve or Wall Street. The stock market might say that the Federal Reserve is raising rates and inflation is coming down, but it might not be the case.
The bond market is telling a completely different story, by the way, and this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German bunds, they're all inverted. They're all inverted. Now, inversions happen, just meaning the longer term rate is lower than the short term rate. Now, this is in the Treasury yield curve. They're inverted from 1 month to 20 years. It's not like, people talk 2s and 5s and 5s and 10s. And 1 month, a 1 month bill is yielding more than a 20-year note. Okay, that's inverted across the entire yield curve. Euro-dollar futures, same thing. The inversion kicks in. It doesn't kick in immediately because the Fed does control very short-term rates and they're raising them, but the kink kicks in like in March 2023, which isn't that far away. And bunds have never been inverted. They are now. Even the inversions that have happened in the past, which are rare, have not been as steeply inverted as they are now. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no, this is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. I better, if I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse adverse change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on, credit losses start going up, and then they just turn off the spigots and they raise standards, they stop doing loans, and then interest rates will start to come down. But interest rates peak after the recession has already begun. So interest rates may not have peaked yet. I mean, even the treasury market. So that's not unusual.
Jim Rickards believes that we are in a triple greatest bubble of all time that includes real estate, stocks, and other asset classes. The bond market is telling a completely different story and indicating that we might be headed for a recession. This is the best single indicator of a recession, and the last time we saw anything like this was 2007, just ahead of the 2008 financial catastrophe. The stock market believes that it's a Goldilocks soft landing, but the bond market is saying that it's going to get worse, and it's actually too late for the Fed to do anything about it.
So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. The standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, and based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. That means they're going to make it worse. They're going to make the recession even worse. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. And we've seen this movie before. This is exactly what happened in 2018. I mean, the Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets.
What do you think about this video? Comment down below. Don't forget to like and subscribe. This is Nifty Invest. We'll see you in the next video. Hey guys, welcome back to Nifty Invest. In this video, Jim Rickards discusses the relationship between interest rates and the business cycle and the different indicators that suggest an economic downturn may be on the horizon. He notes that interest rates are a lagging indicator and that business owners, entrepreneurs, and medium-sized businesses are often the first to notice when a recession is imminent. He also points out that while the stock market is predicting a soft landing, the bond market is signaling that a recession is coming, and that the inversion of yield curves is a particularly worrisome indicator. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. But the stock market is saying, yeah, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, this is the soft landing Goldilocks scenario where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks. If you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3 in the sense that it's real estate, stocks, and other asset classes. So yeah, I do. That is my view, but it's shared by a number of other analysts. 1929, everyone's like, yeah, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. That was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happens. So yeah, we're down. Nasdaq's down. Bounced back a little bit in recent days. Down close to 30%. Down. The S&P down over 20%. We're in bear market territory. But that's just the beginning. That's not what a full bear market, full market adjustment looks like in the face of the kind of recession that I expect.
Jim Rickards explains that interest rates are a lagging indicator, and that people like to question how they could go up if we're in a recession. However, as we get closer to a recession, business people like entrepreneurs, restaurant owners, and taxi drivers are the ones who figure it out first, not the Federal Reserve or Wall Street. The stock market might say that the Federal Reserve is raising rates and inflation is coming down, but it might not be the case.
The bond market is telling a completely different story, by the way, and this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German bunds, they're all inverted. They're all inverted. Now, inversions happen, just meaning the longer-term rate is lower than the short-term rate. Now, this is in the Treasury yield curve. They're inverted from 1 month to 20 years. It's not like, people talk 2s and 5s and 5s and 10s. 1 month, a 1 month bill is yielding more than a 20-year note. Okay, that's inverted across the entire yield curve. The Euro-dollar futures, same thing. The inversion kicks in. It doesn't kick in immediately because the Fed does control very short-term rates and they're raising them, but the kink kicks in like in March 2023, which isn't that far away. And bunds have never been inverted. They are now. Even the inversions that have happened in the past, which are rare, have not been as steeply inverted as they are now. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no, this is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then Then they just turn off the spigots and they raise standards, they stop doing loans, and then interest rates will start to come down. But interest rates peak after the recession has already begun. So it's not, so interest rates may not have peaked yet. I mean, even the treasury market. So that's not unusual.
Jim Rickards believes that we are in a triple greatest bubble of all time that includes real estate, stocks, and other asset classes. The bond market is telling a completely different story and indicating that we might be headed for a recession. This is the best single indicator of a recession, and the last time we saw anything like this was 2007, just ahead of the 2008 financial catastrophe. The stock market believes that it's a Goldilocks soft landing, but the bond market is saying that it's going to get worse, and it's actually too late for the Fed to do anything about it.
So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. The standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, and based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. That means they're going to make it worse. They're going to make the recession even worse. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. And we've seen this movie before. This is exactly what happened in 2018. I mean, the Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets.
What do you think about this video? Comment down below. Don't forget to like and subscribe. This is Nifty Invest. We'll see you in the next video. Countries like Switzerland, Germany, Austria, China, and various Asian nations have maintained a strong affinity for gold. In contrast to the United States, where gold investment is often overshadowed by more traditional financial instruments, these countries have a deep-rooted appreciation for the precious metal. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
They are accelerating their purchases, and I do think it's a sign of things to come. Now, when you talk about retail, so everyday investors, Americans, I love America, but I've kind of given up on Americans and gold. They just, there are people who have positions, and, your hedge funds will have paper gold, they'll do gold futures, but the everyday American, it's been, 40 years at this point of being miseducated on the topic of gold. So they're not very much into gold. You go around the world, you get very different results. Switzerland, Germany, Austria, they love gold. Of course, China, Asian countries. I think Australians have a much better sense than Americans do. So there are the buyers of gold. But you say, well, okay, well, who are the big buyers of gold? The answer is the central banks. Now, right there, that should tell you something. So these are the most powerful, most plugged in, most heavily monetary institutions in the world. And they're the ones buying gold. Now, they would have you believe that gold's not money, gold serves no purpose. It's the first ones to say, John Maynard Keynes said it was a barbarous relic, which he never said, by the way. He said something, he used the phrase barbarous relic in reference to the gold exchange standard of the 1920s, which was a hybrid gold foreign currency standard, but the foreign currency is not gold. So he said that's a barbarous relic, but he never said that about gold himself. And actually, toward the end of his life, he favored at Bretton Woods. He favored a global currency called the backward, backed by gold. And it's not guesswork. There are papers he published at the time, and that was rejected by the United States, which kind of ran the show. Partly because well, not to get too down in the weeds, but our Undersecretary of the Treasury, who was our representative at Bretton Woods, was a Stalinist agent. He was a communist. This didn't come out until the 90s, after the fall of the Soviet Union, when a lot of classified information was released, so KGB files, etc. But it was revealed and fully documented in a book by Ben Style called Battle of Bretton Woods, that he was a communist agent. So what was he trying to do by insisting that, by running Keynes's idea off the road, insisting that the US dollar be the anchor? He was trying to destroy the British Empire, which he did, because he knew that there were far more claims on the Bank of England than they had gold, and that would be inherently unstable, and that would derail sterling as one of the global reserve currencies and undermine the British Empire, which it did. So that's a little bit of a backstory, but it goes to the point that Keynes was an advocate for gold at different times in his career and at the end of his career, and that when the central banks are buying, that should tell you something. Now, I've said for years, I've always pointed to Russia and China. Russia has almost quadrupled their gold reserves in the last 12 years, starting in 2009 through 2021. They've almost quadrupled, pardon me, from about 600 tons to about 2,400 tons. China, the same, not quite, from about 600 tons to about just under 2,000 tons that they report. But they're non-transparent. They have a lot more gold than that stashed in something called SAFE, the State Administration on Foreign Exchange, which is a secretive Chinese sovereign wealth fund run by an ex-PIMCO guy, by the way. He knows what he's doing. And they're non-transparent. So the People's Bank of China is kind of transparent. SAFE is non-transparent.
The crux of Jim Rickards' argument lies in the behavior of central banks, the most powerful and influential monetary institutions globally. Rickards highlights that central banks, including those in Russia and China, have been steadily increasing their gold reserves over the past decade. Russia, for instance, nearly quadrupled its gold holdings from 2009 to 2021, while China, although less transparent, has also significantly boosted its gold reserves. What is particularly telling about central banks' interest in gold is that they are the custodians of monetary policy and are deeply ingrained in the global financial system. Rickards argues that their preference for gold should not be dismissed as mere nostalgia for a bygone era when gold was the primary backing for currencies. Instead, it reflects a strategic decision to safeguard their wealth and financial stability in an ever-evolving economic landscape. Jim Rickards dispels the notion that gold is an outdated relic, as some critics argue. He points out that even renowned economist John Maynard Keynes, often cited as a critic of the gold standard, had different perspectives on gold throughout his career. Keynes indeed criticized the gold exchange standard of the 1920s, but he later advocated for a global currency backed by gold.
So every 6-7 years, what you'll see is the People's Bank of China will announce, oh, we've increased our gold reserves by 400 tons or 500 tons or whatever, as the case may be. And well, it sounded like they went out the night before and bought 600 tons. Good luck trying that. You can't do it. Well, what it means is that SAFE took some of the hidden gold that they had been acquiring slowly and in an accounting entry moved it over to the People's Bank of China, and boom, there's 500 tons overnight. But of course, they had it all along, and they still do. So they probably have more. So Russia and China are big acquirers, again, tripling and quadrupling their gold reserves. But now we're seeing it in a lot of other countries. The Philippines, Vietnam, Mexico, Iran is a major buyer, but non-transparent. Turkey has drastically increased its gold reserves. These are major countries, and they're adding. So I look at that, and there's very good data from the IMF and the World Gold Council, so you can find this information. But the one that was just like not doing anything was Japan. They had about 600 tons. But they had 600 tons for 30 years. I went back and looked at all the old data. It was like 30, never, that was boring. Who cares about Japan, 600 tons? And then just about, at this point, about 6 months ago, so late last summer, they bumped it by, I believe it was 50 tons, perhaps more. I gotta look at the exact number, but it was over 50 tons overnight. It just went from 600 tons to 650 tons, just like that. Well, here's what you know. Same thing I said about Russia. You can't buy 50 tons overnight, or you couldn't even do it in a month. I mean, the dealers would be working the order, it would be disruptive to the market. It would leave a lot of fingerprints, put it that way. But what it tells you is two things. Number one, Japan had the gold all along. They had it in some sidecar or side account or Ministry of Finance hidden account, what as the case may be, and they chose to move it over to their reserve position, which they can do. That's an accounting entry, but they had to have had the gold all along, because you can't buy that much that fast. So then that begs the question: well, why all of a sudden? Why now, after decades of holding your gold level constant, do you all of a sudden step up in a big way? A lot of possible answers to that. One, China's making noises about invading Taiwan. Well, if you're going to invade Taiwan, why not invade Japan while you're at it? It's just another chain of islands as far as the Chinese are concerned.
Rickards emphasizes that the misinterpretation of Keynes' views on gold has perpetuated the misunderstanding of the precious metal's role in the modern financial system. In doing so, he underscores that gold has historically played a vital role in global monetary systems, and its significance should not be underestimated. As central banks continue to accumulate gold reserves, the question arises: why? Jim Rickards suggests several reasons. First, gold serves as a hedge against the US dollar's potential devaluation due to inflation or loss of confidence in central bank currencies. Second, it can act as a buffer in times of economic crisis and geopolitical uncertainties. Rickards also speculates that the actions of central banks like Japan, which recently increased its gold reserves significantly, could be driven by concerns over the reliability of the United States as a geopolitical ally. The aftermath of the U.S. withdrawal from Afghanistan has left many nations questioning their dependence on U.S. protection, leading some, like Japan, to fortify their financial and military positions.
And after this happened right around the time, maybe shortly after the U.S. debacle in Afghanistan, which was, the worst foreign policy, military disgrace, humiliation in U.S. history that I can remember. I don't know how far you'd have to go back to find a worse turn of events. And that there it was. Well, all of a sudden, allies all over the world, Israel, Japan, Taiwan, they're questioning the United States. Like, hey, we're under your nuclear umbrella. You stand by us through thick or thin. Here you leave Americans behind enemy lines. So perhaps, now this is speculation, but perhaps Japan sees the threat to Taiwan, feels they may be in the sights of the Chinese, feels the United States may not be as reliable as one had thought, and says, well, we now have to step up a little bit financially, militarily, etc. And they're doing that. But that aside, that's a little geopolitical speculation, but that aside, the gold is real. They put it on the books. So the biggest buyers of gold in the world are the central banks. By the way, from 1970 to 2010, central banks were net sellers. Now, some bought and some sold, but on net, they were net sellers. We had Brown's bottom in 1999 when the UK sold half their gold at the lowest price in about 60 years. they literally hit the bottom at about $200 an ounce, give or take. But since 2010, central banks in the aggregate have been net buyers, and that buying is accelerating. So what does that tell you? It tells you that the most knowledgeable players in the world are adding gold to their reserves because they consider that a prudent hedge to the US dollar, if you have US dollar inflation, or to collapse of confidence in central bank currencies generally, or they're just saying, hey, we're part of the club. By the way, here's a good trivia question for you, Shay. If you're in a bar and with a lot of brainy economists around, ask them, bet them a drink on this. Ask them what percentage of U.S. reserves are in gold. The answer in China is about 2%. Russia's about 20%. You know what the percentage is for the United States?
It's got to be 0.5%. 75%.
75.
75%. The U.S. does not rely on euros and Aussie dollars and Canadian dollars for its reserve position, a little bit, but 75% of U.S. reserves are in gold. So don't let any central banker, don't let Jay Powell or Janet Yellen or any of these others tell you that gold's not a monetary asset. We have the largest gold stash in the world, and 75% of our reserves are in gold. So that's the U.S. As they say, watch what they do, not what they say.
I would say that the Fed's monetary policy will fail or is failing, and fiscal policy will fail, is in the process of failing, even if gold didn't exist. If you didn't have gold as a multi-millennial monetary standard, even if gold wasn't there as a reference point, which of course it is, but these policies are failing anyway, and there are a lot of reasons for that. Whenever I hear fiscal stimulus, I say, well, no, the Fed can print money all day long and the Congress can spend money all day long, but don't call it stimulus. It's not going to have any stimulative effect. We're way past the Keynesian multiplier, which is now below 1, meaning if you borrow $1 and spend $1, you don't even get $1's worth of GDP. You get some numbers, 70, 80 cents. Forget about the multiplier. It's actually now, a divide or something that reduces GDP. Well, you don't get the GDP for the borrowing. And same thing with monetary policy, because unlike Milton Friedman, the monetarists, the neo-Keynesians, the Austrians, and everyone else, money printing has nothing to do with inflation. And they seem to, well, I don't know if they ever knew it, so I can't say they forgot it. So all the money printing and all the deficit spending will not stimulate the economy. And that's true anyway, but gold is signaling that. Look, all markets try to be forward-leaning. Some do it more successfully than others, more accurately than others, but they try. I would say that, people say, the stock market is an efficient discounting mechanism for future events, for what they see in the future. And they look into the future. Here's the forecast. They pick out a discount factor. They present value it and say, here's where stocks should be today, based on where things are going to be, 6 months or a year from now. And that's what they do sort of mathematically and analytically, except they're always wrong about the forecast. You got to get the forecast right if the discounting process is going to mean anything. So markets go through the process, but they always get the future wrong. They're not very good at predictive analytics. So this creates what I call the gap between the perception and the reality. Reality always wins, but not right away. Sometimes it takes a while. Gold, on the other hand, has very high predictive analytic value, number one. Number two, it's more forward-looking. So gold's kind of telling you where things are going to be maybe a year to 18 months from now instead of 6 months from now. And so, so gold is signaling that monetary and fiscal policy will fail and something else will be tried. And that ultimately will result in a much higher price for gold. So gold's just saying, well, let's do it now. Look, I've got gold at $15,000 an ounce by 2025. If I'm wrong about that, it'll be sooner and higher. But that's, well, I consider that a conservative forecast. And we can maybe take a few minutes to go into the analytics behind that. As I've said before, you've heard me say, I don't just throw numbers out there to get attention. I don't really care. I do care about getting the analysis right. There's a number of different techniques, and what's interesting is they all point in the same direction. So it's got to go to 3,000 before it gets to 15,000. It's got to go to 5,000 before it gets to 15,000. So that's my kind of long-range forecast. But it could go down tomorrow, and I'm like, I don't get depressed when it goes down. I don't get euphoric when it goes up. I know where it's going in the long run. That's the important thing for if you're trying to preserve wealth and make money. Nothing wrong with making money. I'm all for it, but sometimes preserving wealth, risk aversion is a higher priority than just making a lot of money in the short run. But either way, gold will serve that purpose and and preserve wealth over that time period. Could it go down tomorrow? I guess, yeah. But all the vectors are pointing up very strongly. I'll give you a concrete example. There are three things that drive the price of gold fundamentally. One that you've already mentioned, which is real interest rates. The lower the real interest rate, the higher the price of gold. Number two, supply and demand. You learn it in your first 3 days in economics, but it still works. And then number three is geopolitical risk.
call it risk off or fear factor, whatever you want to call it, but I think of it in geopolitical space. Those three vectors don't all have to point in the same direction. You could have a situation where geopolitical risk is high, pointing to a higher gold price, but real interest rates are really high, and that would point to a lower gold price, etc.
Small ebook, big impact, The Wealth Tree. The only 4 ways that will make you financially free forever. Download it here for free.
But right now, all three of them are flashing green, or maybe flashing gold. The real rates are coming down. They're still high, by the way. I always have to just roll my eyes when really smart people, Dan Isaacson, Bill Gross, Jeff Gundlach, and I admire them all, and I follow them all. But they've all been carried out feet first on this, bond bubble thing, the greatest bond bubble in history, and short bonds, and the interest rates have nowhere to go but up. They're just failing to distinguish between nominal rates and real rates. Nominal rates are low. Real rates are not low. When I say low, I mean, show me negative 4%. That's a low real rate. Yeah, you can pick your notes or your bills or whatever, but I usually use the 10-year note rate, 10-year treasury, because it's a good proxy for building, construction, long-term investment. People don't borrow overnight to build a building. They borrow for 7 years if they can, et cetera. So to me, that's my proxy for sort of economic growth and inflation forecasting. That's it's about 70 basis points today, etc. But inflation is, 1.5, take your index. So that puts the real rate, maybe negative 25, negative 50 basis points. Well, thank you very much. But, I remind people in 1980, I borrowed money at 13%, but inflation was 15%. And my borrowings were tax deductible, and the tax rate, I lived in New York City at the time, was 50%. So my real after-tax rate was about negative 7. That's a low real rate. So the point is, we have a long way to go. And it doesn't matter, people are interested whether the Fed's going to pursue a negative interest rate policy, take the target rate on Fed funds below zero. Legally, they could. It's already been done in Europe and Switzerland, Japan, a few other places. I don't necessarily forecast that. I don't think the Fed necessarily wants to go there. But you can have negative yield to maturity on a 10-year note. Just whenever the premium is greater than the present value of the coupons, it's a negative yield to maturity. So you can get there. You can get deeply negative rates in secondary market trading, regardless of what the Fed does. And that will happen. And so, in the DV01, dollar value of 1 basis point is higher as the absolute level of rates gets lower. That's just, duration, just bond math 101. So we're going to have huge capital gains in 10-year notes as the yield to maturity goes, towards negative 1%. But that's going to be an enormous boost for gold. We're not even there yet. We're seeing you're seeing kind of a spike in gold prices when real rates are still, relatively high. They're only mildly negative. I was declarative when I said printing money does not cause inflation, and it doesn't. Again, I'll just use the last 12 years as Exhibit A. We should probably relate to the viewers what does cause inflation. And the answer is velocity, the turnover of money, the lending and the spending. But the problem is velocity is a psychological phenomenon. The Fed can stick the landing on money supply. They can get it down to a couple of decimal places if they want. But if you want to control velocity, which is the key, that's psychological. So what you have to do is change the psychology. Well, what is the psychology right now? It's deflationary. The savings rate in May was 33%. It had been going up. It kind of made its way like from 4% to 7%, but then it spiked to 33%. Well, savings is a good thing. You can drive an economy if you can convert savings into investment, and furthermore, if the investment is productive, unlike what China's doing. But we got some infrastructure or some other projects, R&D that would be productive. That can drive an economy. You don't have to drive an economy on consumption. You can drive an economy on productive investment. But the problem is twofold. Number one, it has a much longer time frame. That's a 5-7 year time frame. And it comes, in the short run at least, at the expense of consumption. Our economy is driven 70% by consumption. If you substitute savings for consumption, you're killing velocity. Because if I put my money in the bank and leave it there, the velocity is zero. And I remind people, $5 trillion or $6 trillion times zero is zero. You can print all the money you want, but if you don't have velocity, you don't have an economy. And so the question is, how do you change the psychology? How do you get and by the way, it makes sense to save. If you're unemployed, you better be saving because you're maybe lucky if you can pay the rent. But even people who are working or still have their jobs, they're worried, maybe I'm next. Maybe they fired the guy down the hall, but maybe I'm next, and maybe I better save more just in case, and so forth. So, and that's not a bad thing. I'm not saying that doesn't make sense. That makes a lot of sense, but understand what it means. It's deflationary. It reduces velocity. It offsets the increase in the money supply, and it's very hard to get out of. Keynes called it a liquidity trap, and he was right. That's what it is. So how do you change the psychology? Well, you need...
Notably in 1980 and 1981, regrettably, analysts anticipate that the recession will surpass expectations, with the bottom potentially falling lower than predicted, perhaps a 30% to 50% decline in the S&P, around 22,100. While we had a brief respite between 2020 and 2023, the situation is worsening in 2023 due to the concurrent financial crisis. The financial crisis is currently brewing, causing widespread panic. If it materializes, the impact will be severe, marking a dark day for America and the world. It's important to note that each financial crisis carries its unique level of impact, ranging from substantial to less significant losses. Predicting the scale and duration of a crisis is challenging, as evidenced by the subprime mortgage crisis from 2007 to 2008, which coincided with a recession, resulting in a disastrous outcome. The expansion of mortgage credit triggered this crisis, enabling widespread borrowing and mortgage acquisition. This mistake led to the collapse of the U.S. housing market, causing many to lose their homes, savings, and jobs. The repercussions extended globally given America's pivotal role in world trade. Discussions on recession, inflation, and deflation aside, one aspect yet to be addressed, referenced earlier, is the possibility of a global liquidity crisis. In 1998, despite the absence of a recession, the financial world faced a near collapse. Such crises can coincide with recessions, resulting in severe consequences. A notable instance is the subprime mortgage crisis from 2007 to 2008. There's speculation that 2023 might witness a collision between a financial crisis and recession, resembling the 2007-2008 scenario. Financial experts, including Jim Rickards, highlight signs indicating such a development. These signs include a diminishing world trade, daily declines in industrial output coupled with rising unemployment, and historically high interest rates for the past 15 years, aimed at combating inflation but failing to curb inflated prices. If there are lingering doubts about the recession and financial crisis, examining the recent state of American banks provides clarity. In just a month, 5 major banks have faced setbacks, such as bankruptcy, FDIC takeovers, and collapses. The combined losses of credit and stockholders from these events surpass $200 billion, sending a clear signal of systemic issues. Efforts by the FDIC to reassure the public include unconventional measures, such as guaranteeing depositors sums exceeding $200 billion for Silicon Valley Bank and Signature Bank. These unprecedented actions, while seemingly noble, are predicted by Jim Rickards to deplete the FDIC insurance fund, ultimately affecting consumers. Moreover, the Federal Reserve's decision to extend more loans to member banks through the Bank Term Funding Program, BTFP, is causing significant turmoil in the U.S. banking system. These moves have intensified public anxiety, particularly among depositors. Concerns arise regarding whether these actions aim to implement new policies or if they are motivated by the interests of a few affected entities. The parallels to the 2008 crisis, where the FDIC guaranteed all bank deposits, echo in current events. As the government faces unrealized losses exceeding $700 billion in U.S. bank portfolios, the continued cash provision to depositors raises concerns about the sustainability of the banking system. The looming question is whether the crisis is truly over, or if the panic is just beginning. Drawing parallels with the 2008 financial crisis, which started a year and 6 months before reaching a critical stage, the current crisis, only a month old, has already led to the downfall of 5 banks. Addressing the broader economic situation, the FDIC's guaranteeing of all depositors and the Federal Reserve's offer of additional loans through BTFP signify pervasive issues. The Fed's guaranteeing of all bank deposits surpassing the $250,000 insurance limit echoes actions taken in 2008 to avert bank runs. However, such measures may strain the FDIC insurance fund, with potential consequences for consumers. As the government grapples with increasing unrealized losses in U.S. bank portfolios, the fear is that continuous cash provision to depositors will hasten the collapse of the banking system. Despite attempts to reassure the public, it remains uncertain whether the crisis is truly averted. The interconnectedness of the banking system and the broader economy becomes evident, reflecting a situation that extends beyond individual instances. The Fed's unusual actions, coupled with the FDIC's extraordinary measures, intensify the prevalent challenges. Considering the gravity of the situation, the looming question is, what should one do? How does one respond to the panic and secure oneself against the impending crisis? While the inevitable cannot be avoided, taking proactive steps to preserve wealth becomes crucial. According to Jim Rickards, the first step is acquiring gold.
Down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out, okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE, I forget if it was 8 or 9, whatever, lost track of QE. He starts QE 8, let's say. And then that takes you into 2020, and here comes the pandemic, and rates go down to 0, and the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen, and it's not clear which, but it's going to be one or the other. They're going to keep tightening and keep tightening and keep tightening, try to get a handle on inflation and crash the stock market. Or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November. But the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either because the Fed doesn't drill for oil. They don't build pipelines and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here.
The renowned economist Jim Rickards continued her speech as follows. The supply chains are deteriorating, but these disruptions in the supply chain did not originate with the conflict. They didn't even commence with the pandemic. They initiated with the trade war led by Trump in 2018. I discovered an excellent book on this topic, authored by Luan Larocco. What's intriguing about her book is that she completed it in late 2019, serving almost as a control experiment. It predates the pandemic. It's convenient to attribute the disruption in the supply chain to the pandemic, which indeed played a role. And the conflict also had its impact. However, we have a meticulous examination of the supply chain's condition before either event, and the conclusion is, it was chaotic. It was chaotic back then due to tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That may seem straightforward because Brazil cultivates soybeans. Well, guess what? You have to transport the ships to Brazilian ports. You have to reorganize all the logistical lanes. That was already happening. The pandemic exacerbated it, and now the conflict exacerbates it even more. Yes, the world is fragmenting. We're disengaging. Globalization is concluding. There will be a new iteration of it. It's not the termination of world trade, but you might witness perhaps the Five Eyes, UK, US, Canada, Australia, New Zealand, and allies in Western Europe forming a new trading bloc while excluding China and Russia. It will resemble somewhat the Cold War. I discussed this with Paul B. However, in the 70s, something similar occurred. It commenced with cost-push inflation. It was the Arab oil embargo in 1973 after the Israel-Arab War. Then the Arabs imposed the embargo on us. quadrupling the price of oil from $3 a barrel to $12 a barrel. It might sound inexpensive, but that's a 300% increase. Subsequently, we experienced a severe stock market crash and recession in 1974, the most severe since the Great Depression at that time. We've encountered more severe ones since, but back then it was the worst recession since the Great Depression. Following that, the Fed intervened and Nixon abandoned the gold standard. Nixon implemented an accommodating monetary policy in '72, a bit earlier for his re-election effort, etc. So, here comes inflation, but along the way, and then there was another oil embargo, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were dual oil shocks. It was a supply-driven cost-push inflation. However, it transformed into demand pull. It evolved into a demand-side scenario that I lived through. I was a young, up-and-coming lawyer at Citibank, a senior officer living in New York City. That was a time when if you desired anything new, furniture, TV set, vacation, anything, you rushed out. You dropped everything, rushed out, and did it because the price was escalating so rapidly. This is instructive in two ways. Firstly, it illustrates that the Fed is consistently behind the curve. It shows that these issues can persist much longer than anticipated. But more crucially, because I believe things will happen more swiftly now, it demonstrates inflation shifting from cost push to demand pull, transitioning from a supply-side matter to a psychological shift on the consumer side. Volcker managed to suppress it, but at a substantial cost. Unemployment reached approximately 11%. He elevated interest rates to 20%. How does that feel? Mortgage holders, student loan holders, and others? 20%. We're talking about 40% on credit cards in that era. People tend to forget, well, doesn't inflation mean you have high growth or whatever? At least low unemployment. No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We experienced 3 in 1974, 1980, and 1981, which persisted until 1982. By the way, people lost confidence in the dollar in the late 70s. Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now it was Treasury.
You mentioned a fresh perspective on the case for gold, highlighting an impending confrontation within it. Referring to the analogy of tectonic plates, I envision a symbolic representation, perhaps a twig, signifying the fragility of people's confidence within this context. During the keynote presentation at the Sprott Natural Resource Symposium, you began by emphasizing the significance of confidence. Could you elaborate on why this aspect holds such paramount importance in your presentation?
Absolutely. The essence of my presentation focused on gold as the once-in-future money. Historically, gold served as a widely accepted form of currency, yet today, the prevailing belief is that it's merely a commodity, not money. Personally, I view it differently. I consider gold as money and analyze it through that lens. However, this perspective isn't commonly shared. The general consensus disregards gold's monetary attributes and perceives it solely as a commodity. Gold had its prominence as money in the past, but presently, it's not widely acknowledged as money except by a minority, including myself. Yet, I firmly believe it will regain its status as money in the future. The question then becomes, what will drive this shift in perception? To lay the groundwork, I started by questioning the fundamental definition of money. Through various illustrations encompassing feathers, clamshells, euros, gold, silver, beads, digital currencies, credit cards, and Bitcoin, I aim to highlight that throughout history, these diverse forms have all served as money at different times and in specific societies. Criticisms often surface, asserting that certain currencies, like gold, paper dollars, or Bitcoin, lack tangible backing. However, I argue that the common thread among all forms of money is their reliance on one crucial factor: confidence. The crux lies in the confidence shared between individuals in considering something as money. If two parties mutually trust an item's value and its exchangeability for goods and services, it inherently becomes money. This confidence, however, rests upon trust and is exceedingly fragile. Losing this confidence can happen swiftly and is incredibly challenging to restore. Money, as a construct, is far more fragile than commonly perceived because its foundation is rooted in the psychological aspect of confidence, rather than the sheer quantity in circulation. My concern lies in central bankers' disregard for this fragility. Their assumptions about unlimited money printing might lead to crossing an invisible confidence threshold, resulting in a rapid loss of trust and subsequent inflation. In essence, The real essence of any form of money isn't solely tied to economic concepts like printing quantity, but hinges greatly on people's confidence in it. Ignoring this critical aspect poses a significant risk, potentially leading to unforeseen economic consequences in the future.
Certainly. Jim, during your presentation, there was a slide that caught the attention of the entire packed audience, the one where you briefly touched upon the war on cash. However, what piqued interest was your mention of an impending war on gold in the future. Could you elaborate on this aspect as well? It seems like an intriguing and significant perspective that the audience would benefit from understanding further.
Sure. A lot of people have heard the expression war on cash. Governments don't like cash. It's hard for them to trace. And they associate cash with drug dealers, terrorists, and tax evaders. Right. But there are lots of legitimate reasons to have cash. And people who have money in the bank think they can get cash whenever they want. And I make the point that you really can't. You may think you can, but go down to a bank and ask them to give you $20,000 in cash. Let's say you've got $50,000 in your bank account, and you say, I'd like some cash. Please give me $20,000. They might ask you to come back 3 days later. They might not have that much cash. They'll definitely ask the branch manager to come over because the teller won't be able to handle the transaction for $10,000 or more. They will file a report with the government, the currency transaction report. But even for amounts significantly less than $10,000, if they don't think you've got some cash business like, I don't know, maybe a pizza parlor or something like that, they might file a suspicious activity report. My point is, you won't be treated like an honest American or an honest Canadian or a citizen of the world. You'll be treated like a criminal. They'll do everything possible to discourage you, and you'll find that you actually can't get the cash you think you have. Plus, there are countries in the world. Sweden, I think, is the leading edge that are going to all digital money. They want to get rid of money, meaning paper money or coins. And coins aren't valuable because they're not made of silver. They're made of zinc or copper alloys and so forth. They want to get rid of all paper and coin type money and go to completely digital money. So you have your debit card and your credit card and your wire transfers and your online transfers and all that, but no actual paper or coin type money. Even for the countries or monetary groups that still have paper money, they're reducing it. For example, the Eurozone, the 19 countries that make up the euro, just got rid of the 500 euro note. Until recently, you could get a 500 euro note. There's some still in circulation, but they're going to stop making them. So the next biggest denomination will be the 200 euro note. The United States used to have a $500 bill until the late 60s. Then they got rid of that. Now they have a $100 bill. But the $100 bill of the late 60s, when it was the largest denomination, is only worth 20 cents today in terms of 1960s purchasing power. Even that is kind of going away, not in terms of zeros, but in terms of what it's actually worth. So there's a full-scale war on cash. The point I'm making is that people say, how's it going? I said, well, it's over. The government won't think. You may think you can get cash, but you can't. But you can get gold. There's nothing stopping. I was in London recently. I went to a place called Sharps Pixley. It's a gold bullion dealer right on the corner of Jermyn Street in St. The kind of fanciest shopping district in London. One of the most attractive retail locations in the world. And you can walk in right off the street. It looks like a bank, but it's not a bank, except maybe it is a gold bank. Walk out to the teller, say, I'd like to buy 1 kilo of gold. They'll say, fine. That's $45,000 and pay with a credit card. Or I want to buy a couple of gold coins. And they'll say, fine. They won't say dollars. Obviously, they'll say pounds, a couple of £1,000, etc. They'll give you the gold there. If you want to store it, you can store it. They have safe non-bank storage. If you want to walk out the door with it, that's okay too. It's kind of like a knight in the 19th century in London. You could walk up to a normal bank and give them paper money and they would give you gold and you could walk out with it. So Sharps Pixley has reinvented that kind of bank of gold concept. There are very few barriers to owning gold. Sprott has a very good gold fund. There are other gold funds of that type around the world. You can store it yourself. You can get non-bank storage. Don't put it in a bank. I don't recommend that. But non-bank storage is fine. So right now you can get gold. Not at a fixed price. It's not a gold standard, but at the market price. I think the governments haven't really caught on. They've spent so many decades disparaging gold, making fun of gold, ridiculing gold holders and sort of running gold off the road that I don't think governments are alert to the fact that gold is money. And if you make cash go away, you're actually going to elevate the value of gold to a lot of people. And so I expect that when they suddenly wake up one day and say, wait a second, all these people we try to chase out of paper money, they're going to gold. There'll be a war on gold. And my advice to people interested in gold is get it now while you still can. Are you waiting for? Some things are changing quite a bit. Some things haven't changed. So some of the fundamental forces are the same. Now, superficially, we've had a lot of news. We've had Brexit. We've had the unexpected rise of Donald Trump. We've had a Turkish coup, and we've seen Venezuela implode. So there have been a lot of very important, very significant political and geopolitical developments can impact gold or commodities one way or the other. But certain things haven't changed. And I think these are important to focus on because they really drive the price of all commodities. The number one thing is the struggle between deflation and inflation. And this is something actually I talked about in my first book, The Currency Wars in 2011. I made the point because people look at the time series of price indices and we haven't had a lot of either. They've been pretty steady at a pretty low level, around 1.5%, sometimes a little hotter, sometimes a little cooler, at least in dollars. Now, actually, some of the other economies around the world, you're actually seeing deflation in Japan and Europe and elsewhere. But that is because the world is in a naturally deflationary state. The world wants to deflate. Why is that? Demographics. You not just have a slowdown in growth. Globally, you do. But in certain countries, you actually have declining populations. The population in Japan is declining. The population of Russia is declining. The population of China has leveled off and may start to decline. The only reason the US doesn't have negative population growth is because of immigration. The actual birth rate of Americans, ex-immigration, is sort of flatlining. But we do have some population growth because of immigration, but that just means it's coming from somewhere else. And then debt and deleveraging. Talk about helicopter money. We'll just give people money and they'll go spend it. Well, they might not spend it. There are two other things you can do with it. You can save it or you can pay down debt. So just handing out money on street corners doesn't necessarily get you the velocity or the turnover of money or the spending or the GDP that you want, because people might actually, as I say, put it in the bank or pay on debt, and that is going on. So that's debt to leveraging. The third one, of course, is technology, which is a good thing. People say there's bad deflation caused by bad policy, but there's something called good deflation. Maybe we should have another word for it. But when your standard of living goes up, not because you're making more money, but because your cost of living goes down for the same amount of money, you can have a better lifestyle because things are less expensive. And that was predominant in the United States. For example, in the late 19th century, when it was an age of invention, you had the McCormick harvester, the expansion of the railroads, the telegraph, the telephone, the phonograph, and movies. All those things came in the late 19th century, maybe very early 20th century, all of which lowered costs and made people richer without more money, just meant they could do more things were less expensive. So debt deleveraging, deflation, debt deleveraging, demographics and technology are causing. I call that the natural state of the world. However, central banks cannot have deflation. They cannot allow it. And I have this debate with our friend Harry Denton and Gary Schilling and others, because they do the deflation analysis I just went through, and I agree with them on that. I think that analysis is correct, but there's a countervailing force, which is central bank policy. Governments cannot have deflation because it increases the real value of the debt. I mean, governments are over-indebted as it is. Japanese debt to GDP ratio is over 250%. Corporate debt, actually corporate, individual, and government debt in China to GDP ratio is over 300%. I mean, these are huge numbers. People pick on Greece, but the rest of the world looks a lot like Greece or is getting there fast. So deflation increases the real value of debt. So if you're over-indebted to begin with, the last thing you want is deflation. There are other reasons why governments don't want deflation, but they're determined to stop it. So you've got these two tectonic plates. There's the natural tectonic plate of deflation, but there's the policy plate of inflation, which is money printing, currency wars, QE operation, twist, all the central bank toolkit, negative interest rates, zero interest rates. They're pushing against each other. So it kind of looks stable from the outside, but it's dynamically unstable, going to snap. The question is, which way would it go? Central banks could throw up their hands and it could go deeply into deflation, or central banks could pull a few more rabbits out of a hat and it could go into inflation. That kind of monetary instability is part of the case for gold, kind of part of the new case for gold, as I call my book. But the point being, that hasn't changed. This has been going on for 5 years, and except that the forces keep getting stronger. The forces of debt deflation, negative interest rates, deleveraging get stronger. The forces of money printing and policy, and I think we'll soon see world money in the form of special drawing rights, or SDOs. So these forces are not only coming together, they're getting more powerful, and they're going to snap when no one knows. But you can say that it certainly will happen. The effect will be dramatic. When it does happen, I definitely want to own gold, at least for part of my portfolio. But I do have the sense that we're getting closer to some very significant break in the system.
Slowing industrial output, slowing retail sales, and importantly, for investors, a very sharp decline in inflation. So this is one of the kind of mystifying points about the U.S. stock market. I mean, it seems straightforward to me, but the market has their own dynamic. They're saying, well, if the Fed raises rates the way I've described and they cause a recession, the Fed's going to have to cut rates. That's called the pivot, the Fed pivot, and lower rates are good for tech stocks, so buy stocks. But think about that for a second. What if inflation comes down faster than the Fed thinks? And I think it may, by the way, I'll return to that. What if inflation comes down really fast and they get to the target rate sooner than they think? Does that mean they might have to cut? Well, it might, but what's good about that for stocks? I mean, if that happens, no one ever says, why did that happen? They just say, well, inflation may come down, interest rates may come down, so buy stocks. It's like, well, inflation may come down, interest rates may come down, but if it does, it's because we're in a very severe recession, exactly what I'm forecasting. And so if that's the case, stocks are going to plunge, 30, 40, 50%. So don't root for lower rates, or if you're forecasting lower rates, understand what that means. It doesn't mean the Fed chickened out. It doesn't mean life is wonderful and you should buy tech stocks. It means that we're in the very severe recession that I described, and I think we will end up there. And therefore, stocks are going to plunge. So, be careful what you wish for, as they say. My forecast is, yeah, they are going to raise rates. They're going to over-tighten. They're going to cause a very severe recession. And when they do, they may pivot at that time, but it won't be for good reasons. It'll be for very bad reasons, meaning we're in a recession and stocks have plunged. So don't buy into the Wall Street chatter as far as that's concerned, because as I say, the Fed's going to over tighten.
Now, why isn't the Federal Reserve aware of this? Well, because they never are. Because they have the poorest forecasting record of any institution I can think of. Their entire history since 1913 is one mistake after another, and this will just be the latest in the long series. So, just to kind of recap, the Fed is on a trajectory. We know precisely what it is because they informed us. All you have to do is listen to them and believe them. They're going to increase rates, let high rates do their work, and observe the inflation come down, and maybe in 2024 decrease rates. What I anticipate is they are going to raise rates for the next couple of meetings exactly as I've outlined, but they're going to over-tighten. The signs of recession are already present. The Fed's not looking at them. I'll come back to what they are, by the way. And we'll be in a very severe recession for a lot of reasons. And that's going to mean a plunge in stock prices. So if the Fed cuts rates, don't cheer too loudly, because it'll be in a world where severe recession, higher unemployment, and crashing stock prices are the norm. I'd like to conclude on, I can't call it a joyful note, but a global liquidity crisis. Now, I talked about a global recession, and people go, well, isn't that like a liquidity crisis? No, a recession or a depression is very different than a liquidity crisis or a financial panic. They're two different things. They can and do happen separately. In 2008, we had both. In 2008, the recession or depression and a financial panic converged, so they can happen together, but they don't have to. They can happen individually. What we're in for visually looks like a global financial crisis and a global recession at the same time, coming sooner than later. Now, why do I say that? There's a global dollar shortage. People go, wait a second. The Fed printed $9 trillion, which they did in 2020. It's come down since then, but they did print that much money. How could there be a global dollar shortage? What people don't understand is that behind the curtain off-balance sheet, this is off-balance sheet. You've got to go read the footnotes and understand what you're reading. There are $1 quadrillion of derivatives. And for those not familiar with quadrillion, 1 quadrillion is 1,000 trillion. So, I just said the Fed printed $9 trillion. Maybe it's down to 7 trillion, but you have $1 quadrillion of derivatives, and they have to be supported with collateral. Not 100%, not even 10%. I mean, 1% or 2% is enough. But when you're in a liquidity crisis, banks are extremely choosy about which collateral they'll accept to support this quadrillion-dollar inverted pyramid of derivatives. And right now, what they're saying, because this evolves, it gets worse. It doesn't happen overnight. It can become acute overnight, but it happens over the course of a year or longer. What we see, the banks are saying, I don't want corporate bonds as collateral. I don't want your mortgages as collateral. I don't even want 10-year treasuries as collateral. The only collateral I want are short-term U.S. Treasury bills. Treasury bills have a maximum maturity of 1 year, 360 days, but there can be 4-week bills, 8-week bills, 6-month bills, etc. That's the best form of collateral. It's the most liquid, easily traded, low volatility, easy to repledge, is by far the best form of collateral. That's all the banks want right now. But if you're a foreign bank, you need dollars to buy the dollar-based collateral. If you want treasury bills that are denominated in dollars, you need dollars to buy the bills. That's why the US dollar is so strong. People go, wait a second, the US has a multi-trillion-dollar annual budget deficit, a massive trade deficit, 132% debt to GDP ratio, $31 trillion in debt. You're going into a recession. How can the dollar be so strong? The answer is everything I just said has nothing to do with the demand for dollars in international foreign exchange markets.
The constant rise of the markets is perplexing, isn't it? Despite the less than stellar state of the economy, ongoing political turmoil, and the overall uncertainty within America, I have some pressing thoughts to share, and I'm eager to hear from our expert, Jim Rickards. Jim, here are the queries. How can stocks continue to climb amidst the looming threat of World War III, ongoing conflicts, soaring national debt, and a chaotic political landscape? Another question that's on everyone's mind is why the stock market seems buoyant despite the barrage of negative news. Investors and Americans alike are seeking answers, Jim. What's your perspective on this perplexing situation?
The S&P 500, the Dow Jones Industrial Average, and the NASDAQ 100 all peaked in late 21 and January 2022. Look at a 3-year chart. Stop looking at a 3-day chart. People in general stop looking at 3-day charts, at a 3-year chart. They all peaked in NASDAQ, peaked in November 2021, and Dow Jones and SP peaked in January, like the first week of January 2022. Those indices are down significantly from where they were almost 2 years ago, or over 2 years ago. So you can talk about the bull market all you want. They're down over the last 2 years period. Now, has there been a rally lately? Yeah, and there have been 4 or 5 along the way. And I'm not saying you can't make money, but I'm saying that in this volatility, up and down, the trend is down. So let's not get too excited about the stock market because the trend is down as I described. Just look at a 3-year chart. You'll see exactly what I'm talking about. Now, where do we go from here? Oh, stock markets are bubbly in the face of something horrible, where we've seen that before. I mean, the stock market during the cycle around the 2007-2008 financial crisis. Remember that crisis started in the spring of 2007, kind of reached a fever pitch in August 2007. That was when Cramer had that famous meltdown with Aaron Bernard on CNBC. They know nothing, etc. But the stock market actually peaked in October 2007. So there we are, 6 months after HSBC warned about rising defaults and mortgages, 2 months after the Fed almost caused a meltdown. Jim Cramer called them out in August 7, but the stock market peaked in October 7. So stock markets go their own way. They're supposed to be leading indicators. They're really not. First of all, the stock market is not peaking. The peak was 2 years ago, right? And the peak is exactly when I said November 15th, 2021. So that's more than 2 years ago, and it still has not regained that peak. So that's the reality. You're right, Matt. There are some rallies, but there's some big dips along the way if you're looking at it. Okay, right now we're in kind of rally mode. Why is it rallying? This started in kind of mid to late October. The Fed signaled that maybe they're done raising interest rates, and maybe they are. We'll talk more about that as we get closer to the, if interest rates go down, stocks go. That's the narrative. Wall Street always has a narrative for no Goldilocks. Soft landing. There's no such thing as a soft landing, by the way. There are hard landings. There are crashes and there are booms, But there's no such thing as a soft landing. You're going down. You're going down. That's why stocks are rallying right now, because interest rates are coming down. But what people don't stop to ask is, okay, interesting. Why are interest rates coming down? Could it be we're in a recession? Could it be we're seeing disinflation? Maybe even deflation? Could it be industrial production was down? Which it was. That was reported the other day. Initial claims are up. That was reported the other day. Unemployment ticked up a little bit. Not huge. But in the last employment report at the beginning of November. This is in addition to the more technical signs. I don't want to get too far in the weeds in terms of inverted yield curves and negative swap spreads and a lot else. Those are long-term or long-range indicators of recession. We've been talking about those for a year. They're very powerful indicators, but they don't tell you the exact timing. But the other items I mentioned, things like industrial production and so forth, are much more real-time, and they're all turning negative. So I would expect the stock market to turn around and kind of go down significantly between now and the end of the year. Early next year, certainly, because by then the data will be undeniable right now. Again, the Wall Street Goldilocks soft landing scenario prevails. It doesn't mean it's right. It just means that that's what people believe. But Wall Street, again, they're just trying to sell you stocks. They'll sell you stocks right up until the day it crashes. I'm actually writing one of our newsletters. I'm writing it today, and I went back and looked at the recessions in 1974 and 1981. And the Dow Jones in 1974 recession, the Dow Jones fell 45%. At today's level, that would be the equivalent of 15,000 Dow points, slightly more. So imagine the Dow Jones down 15,000 points. That's a 45% decline from today's level. And that's what happened in 1974. It's not ancient history. What caused it? Well, it was the Arab. A war in the Middle East, and Arab oil and bar went higher. Oil prices sound familiar. I mean, that's kind of what we're going through right now. We're going back to 2021, the supply shock. And then in 1982, 82, that recession, the NASDAQ fell 38%, so peak to trough. So that's what a real recession looks like, and that's what a stock market crash looks like. And so we could be heading for something like that. But it peaks when it peaks. But by the way, it peaked 2 years ago, so we're not even at the peak. But yeah, it could go down 30, 40%, maybe 50% from here.